Thanks so much for tuning in Talking Point. I'm your host, Neeraj Shah. And the Talking Point today is a very interesting note that Spark Capital has come out with, which speaks about or questions the normally held wisdom of higher commodity and higher crude prices and what they do for Indian markets, because we are in a stage wherein even if crude prices have corrected a little bit in the recent past, they are certainly very, very high. But to my guest, Ganeshram Jayaraman, thank you for joining in. Before we talk about that wonderful note, I have to ask you about what is arguably the biggest development uh, in in the in Indian capital markets for 2022 thus far, probably for the rest of the year, and certainly the biggest development in the BFSI space. The merger of HDFC and HDFC Bank came out of the blue. A lot of people have been talking about it for years now, Ganeshram, that they should do it, so on and so forth. What is your take on what it does for the two entities combined?
So, yeah, good morning, Neeraj. It's always a pleasure being on the show.
Thank you.
So, firstly, to discuss this piece of news, I cannot talk individual stocks, but a quick heads up is, see, from the bank's perspective, uh, for their growth objectives, mortgage was extremely important, and uh, given the parent was predominantly the managing the mortgage side of the business, the home loans, it kind of put a kind of a challenge on the bank's growth outlook. And from the parents' perspective, being a monoline business predominantly, and also being a holding company, had its own set of growth and valuation challenges in terms of holdco discounts, in terms of growth objectives, or where else they could diversify their growth, and also from a management depth, or the longevity of the existing parents management team. They needed to find some answers, and the answers, everybody in the street always knew that the answers was in the bank. But finding an elegant solution in terms of timing, or in terms of the answers for both the CRR, SLR, priority sector, and various other questions. How does the subsidiaries now get subsidiaries of the parent, the non-bank businesses, basically the life and mutual funds and others. So we need to still get some answers. We still want to figure out. As we speak, the call is on, so let's see if that call gives us some answers. But as of now, we don't have absolutely clear answers on how the structure will evolve to become. I think there are a lot of questions there. Maybe it's getting answered as we speak. But yeah, I think for the longer term growth objectives of both the parents' business as well as the bank's business, this was an eventuality, inevitability, and it does. Because the bank's market share in most other loan products, the retail loan products, were reaching levels where beyond which there could have been very little upside for them. But in home loans, there is still a lot of upside, and that will also be the growth driver. And without a meaningful, large presence in that piece, the bank's growth could have been, kind of impacted. And I think this will be a very critical, strategy for the bank, for the merged entity now to be looking at growth in excess of return on equity is now actually possible in the newer context, and that will be a re-rating driver. The fear with investors was, especially over the last 2.5 years, that for the first time in more than 20 plus, in fact, right from the time the bank started, for the first time, growth fell below return on equity. Okay, because their market share, in be it in auto loans or credit cards or personal loans or most other retail segments, had reached 20-25%. And they needed to get the mortgage side of the business right. And the second one is, from the solutions for the longevity of the parent, this was necessary in terms of management continuity and various other questions, which not everything I can speak in a public forum, but kind of this was necessary. And it's a no, we still need some clarity on the structure and how the subsidiaries and how those will play out. regulatory questions are there, CRR, SLR, and others. But I think it answers some key questions for both entities. There are still some unanswered questions still which need some clarity. That's what I will, as the first impressions of this news gives me to point out.
Yeah. Anyways, and just wondering one quick thing before we get to your note, which is very interesting, by the way, and I would urge everybody to stay on and hear that conversation predominantly. But just one quick follow up, Ganeshram, and that is the timing of the same. We kind of probably getting into a large mortgage cycle of sorts, despite what happens to rates. And at a point of time when India as a nation is looking to have upsize its banks per se, this kind of creates that large behemoth entity. Anyways, both were individually large, but not at a global scale. Even this will not be really that global scale, but still a large entity by the virtue of the combined assets. Does that help them actually grow better combined as opposed to what they could have individually?
Absolutely right. That's possible because in maybe about a third of the bank's branches, the HDFC bank's branches, mortgage was not prioritized because of the parents' collection or servicing capabilities. So that will now improve. One, on growth. Second is on costs. There is a lot of cost benefit which the merged entity will now benefit from not necessarily having duplication on either on collections or on people or on there are a lot of duplication which can now be kind of eliminated or used for elsewhere, growth elsewhere. So clearly to me the rub-off of this will be felt, and it will become what, 13 lakh crores, 6 to 7 lakh crores of the parent level. So close to a 20 lakh crore asset book, loan book. It will obviously be so large now that it will meaningfully impact the system, and that will have its own effect on funding as well.
Got it. Okay, Ganeshram, I'll wait for your notes when you guys come out with them post all the calls that you guys have done. It'll be really interesting to understand that. But it's such a big event, couldn't not talk about it. Now to talk about the other big event, Ganeshram, and which is this seemingly a reset of sorts in the world order, in that commodities have been repriced higher, and from the looks of things, unless we reach a resolution, they might stay elevated. Even if they don't stay peak numbers, they might stay elevated for a bit. What are the pulls and pressures, therefore, for a country like India, both by virtue of what happens to crude and by virtue of what happens to other commodities? And then, of course, we'll come to the market impact as well.
Sure. So India has reacted to crude across two different cycles in completely different way, and the street in its collective wisdom tends to look at it as immediate, quantifiable, tolerance threshold led impact. Crude goes above $100, you will have the quick math is done, and that's how the impressions are formed. But that's not how it's always played out. 2002 crude was $23. Iraq war broke out, and crude jumped 40% in a month. In early 03, reactions, alarm bells were similar. Okay, but immediately market's reaction was negative. Okay, but over the next few years, crude kept going up from 30 odd to 40 odd to 50 odd to 60 odd to 70 odd. At every $10, this conversation started. Okay, we used to always have, oh, now inflation will go up, interest rates will go up, and currency will depreciate, and fiscal deficit will deteriorate, and growth will get impacted, margins, multiples, blah blah blah. Same things, absolutely same things. But we absorbed it completely. In a 5-year horizon, crude went up from 23 odd to 80 odd, and then it shot up to 140. Keep that aside. I'm talking, say, from late 02 to say late 07, right? Crude went up 4-fold or 3.5-fold. In that period, we didn't see India react negatively from not just from markets perspective. I'm talking from broader economy's perspective. Growth didn't get impacted. Currency didn't depreciate. Currency actually appreciated 20% in that period. Forex reserves went up 5-fold in that period, from 60 odd to close to $300 billion. So that supported growth. So whereas in the next cycle, crude was about 40 odd in early '09, coming off the financial crisis, and it went up to 120 odd, in a couple of years. It doubled in a year and then went up another 50% the year after, and stayed there around $120 for about 24 months. We were impacted significantly. In current account deficit went up more than 4.5%. Rupee depreciated 50% over literally about a 2-year horizon from say mid 11 to mid 13. Markets went nowhere. Even the characteristics of the sectors which did well were the defensives and the beneficiaries of rupee depreciation. So two cycles where oil has gone up 3-4 fold, and two completely different reactions, not just markets, but the broader earnings, demand, the construct of the economy went through. So it is not as straightforward, simple math to arrive at this judgment. I think the key thing is which phase of the cycle we were in. In the first cycle, it was early cycle for us. What I mean early cycle is corporate balance sheets were almost low, negligible on debt. There were significant deleveraging, and banks had cleaned up their loan books, say late 90s to till about 2003 or something. So systemic liquidity was in surplus mode. As a result, inflation, even if it rose, the central banks hiked rates. Okay, US and in India, bond yields went up. Okay, but the character of inflation was supply led. Character of growth, the growth didn't get impacted, because early cycle the central bank's reaction is not to suppress growth, which it was in 8. When oil went to 140 odd dollars, inflation was double digit, and the central bank cooled down and heated up economy. But today it's not so, nor was it in the first 4 years of a cycle. Whereas in the 2011 to 14 period, it was late cycle. Credit growth had already reached, growth had fueled the growth in the credit growth had fueled the economy's growth. Corporates were high on leverage. The inflation had boosted up earnings. So everybody takes cost pressure led hikes that has an impact. So it was a peak of the cycle earnings. And at that stage, you get a shock like oil shock. Markets react negatively. Central banks react negatively. Okay. So the phase of the cycle matters more than just numerically oil going up, impacting the numbers. So the immediate reaction will be to not look at second order derivative impact. It will be to say oil goes up, oil volume into new price. That will be the new math. But what we look at is the second order impact. So every time oil goes up, the rupee depreciates, and every time rupee depreciates, remittances go up. Okay, that's what we have seen. Now, can that offset? Okay. Second, India's the whole PLI initiatives, can that offset some bit of our non-oil import bill, or can it improve our export quantum? Can the bond yield differentials between India and US are at 500 odd basis points? US's inflation is more than India's. Okay, so logically, I'm talking as a fixed income mindset. We should not see bond outflows. In fact, we should see bond inflows. Okay, so can we see all the bond side, banking sector side flows offset increase in the oil quantum in absolute number, and can as a result our BOB be in check? We think that can happen, and we also think the higher food prices can result in India's food exports getting better, and that can offset some of the fiscal challenges. Okay, and we also anyways think that some of the GST numbers were understated or under budgeted, which can be a buffer. So on the fiscal math too. So one of the concerns investors have is, will we see government's fiscal getting stretched due to higher food subsidies, or higher gas related fertilizer subsidies, or higher LPG subsidies, and will that affect the government's ability to spend on capital expenditure, and will that have an effect on broader growth? We think it's numerically looking at first order derivatives, answer is yes. Second order impact, we think it can offset. So what we are telling investors is, look not at oil as in isolation. Look at it in the context of, can we absorb the shock? Can that or can some other elements offset this and keep the growth engine chugging along? We think in an early cycle that's not something I'll be surprised with. Whereas I think if you look at the markets as a whole, if somebody had told us on Jan 1st, somebody had told us oil will be 50% higher, there could be a war in Europe, and markets will be not just flat, maybe up, you would have said, hey, are you joking? And actually that's what's playing. So markets are actually after the first shock, I think resilience is clearly seen, because we think there are offsetting elements out here which we should not be ignoring. Whereas the first order impact is decisively negative, which is my point. And also one more point, central banks have started hiking rates, and we have seen it in, again, multiple times. The first phase of rate hikes are actually good for equities. Okay, because it is kind of implying that growth is normalizing, and so we will not. We have seen, say, from late 04 till about late 07, central banks both in US, India, they kept rising rates. That didn't hurt markets. Okay, so it is a kind of, again, questioning wisdom, which is what the note was, trying to say that don't just go by a lot of the chatter. It's if you look at details, actually it's not necessarily a negative. Even if rates go up, even if central banks hike rates, bond yields go up, not necessarily negative for growth or for equities. Having said this, the key difference between those cycles and now is multiple. Okay, the 2 years from COVID, if you get kind of related to 2 years from financial crisis, or 2 years from late 02, which is, say, maybe after the tech meltdown and the cycle was starting out, 2 years from then, valuations in the first cycle were a lot lesser than where it is today. Okay, so to me, what I tell institutional investors who take a medium-term view, 18 to 36-month view, is we will tell them we will pick stocks which will have 20 to 25% potential earnings growth coming from ability to take price hikes due to raw material inflation. They have asset turns which give you upside, balance sheet supports you, market share as consolidated, there is upside potential. And then we'll tell them work with 20% lesser multiples. Okay, so can earnings offset lesser multiples and still can we see returns? Okay, so we are working with the base construct is positive on earnings, negative on multiples. Okay, and then trying to figure out if which sectors, which stocks can give us healthy returns, and that's the key call for us. This is not going to be similar to the 2 to 8, nor is it similar to the 9 to 15 kind of cycles. This is every cycle is different.
Every cycle is different. I mean, the other small math, I don't know how much of a difference it makes, but if indeed India is able to import crude at a lower price, or if indeed the much spoken about ethanol movement, CBG movement, etc., gains steam, then whatever little difference it makes to the fuel importing industries. So I don't think it's probably that large a numerical.
No, I think it does have an impact. It does have a change in the overall math, but can it make a difference, meaningful difference for us, or if we do it, and if maybe 1 or 2 other countries follow suit, can it make a difference in the broader, demand supply global dynamics? It's still, I don't think it's reached a stage where you can decisively call for that.
Yeah, agree. So in which case, Ganeshram, I mean, so we've understood the macro through that answer, and thanks for that detailed explanation. So if you are going, okay, so here's the deal, right? A lot of people are bucketing stocks in a way that companies which don't get impacted by the commodity price inflation. So therefore, look at banks, bucket IT companies, bucket banks, and maybe a couple of other pockets in one bucket, and bucket everything else in the other, and then try and pick and choose. What I'm hearing from you is you're probably not doing that. What you're doing is looking at 20% average lower multiple and pricing power. And therefore, would this stretch across segments? And I would presume that you would find value in companies which have been a bit disturbed by this chatter or the narrative around raw material price inflation. That's where you will get the 20% lower valuation. Otherwise, it might be difficult. So, are you largely fishing in that pond?
So yes, we see what we have positioned in our model portfolio is a shift from demand to supply. What we mean is, for the last 10 years, the world didn't see new capacities, not just in India, but most parts of the world didn't see new steel capacities, didn't see new mining capacities or new manufacturing capacities in a lot of segments, including, say, even shipping or container capacities. That's what is leading to a supply-led inflation environment today. So to find a solution to this is not to cut demand, okay? It is to actually increase supply, okay? And that's what we think policymakers will try to make positive. You're seeing it in India. What else is PLI about? What else is, why did we cut tax rates 2 years back? Why did we then solve the vexed tax issues which we as a country had for many years, because the broader picture is we need to get manufacturing or supply increase playing out. So which means from investors' perspective, it is capacity expansion which we are talking. So our largest overweight sector in our model portfolio is industrials, okay, in terms of weight. So we are clearly seeing change from consumption into capacity expansion. That doesn't necessarily mean I'm negative on consumption. We are looking at it very specifically, subsectors, in terms of is there a scope for premiumization in that segment? Is there a scope for unorganized to organized as a driver? Is there a scope for penetration to go up, between various categories of consumption? So subsector specific positive views on discretionary consumption for sure, because IT is hiring, IT is giving wage hikes, and that rub-off will be seen into consumption as well, especially tier 2 cities. Demand, we do see demand picking up, no doubt about it, because that multiplier effect of jobs and hikes will play out in consumption. But the bigger delta in terms of stock prices, because we are talking here of earnings which have been kind of lowballed, it's the capital goods, industrials, engineering, construction, companies which benefit when new capacities come on board, and the financiers of new capacities, corporate banks. And in that context, the first point we discussed is also relevant. Financiers of capex, all kinds of capex, household capex, commercial real estate into data centers or IT hiring will be relevant. PSU companies capex, private companies capacity expansion in sectors like textiles or cement or steel or renewables, the PLI related sectors, data centers, as I was mentioning, that will, so clearly for us, the positioning of the portfolio matters more. The kind of subsectors, the kind of stocks that we pick, which will be beneficiaries of how they have prepared their balance sheet or products or distribution, or how their competition has eased up, giving them room for pricing power. Many sectors over the last 3-4 years have seen a significant kind of consolidation of market share. I'll just give you one example, right? 10 years back, okay, the top 30 developers in the country contributed to 1.5% of the total launches in the country. Today, the top 30 developers in the country are contributing 25% of the launches in the same compare apples to apples. So look at the consolidation, and something like this is happening in about 25 different sectors to subsectors has happened. So the ability to pass on raw material price, it won't happen overnight. No company will shock the customer by taking a 25% price hike, in a quarter or so. But for a period of time, the ability to pass it on is there, and ability for consumers to accept it without a demand impact is coming from the wage hikes, the excess savings in the household balance sheets, the job, the hiring which is happening. All this also contributes to it. So, but when you weigh valuations, when you see how much is priced in, how much isn't, how much upsides can play out to numbers, clearly for us, it's industrials and financiers of the capacity expansion, where we think a fair bit of our model portfolios bias is tilted towards, and that is a very, very important phase. The way we are looking at positioning for the next 18 to 36 months, we look at medium term in our model portfolio positioning, not next, because next 12 months there are hundreds of people already well positioned. We need to look beyond horizon to get that alpha.
Okay. My final question, and I mean slightly over time, but still one final question I'm tempted to ask, and it's kind of a two-part question, Ganeshram, is what kind of havoc can elevated raw material costs put to this thesis, predominantly because capital goods, construction, real estate, all forms of manufacturing, and even defense for that matter, all will get impacted if indeed commodity costs stay elevated. And I was talking to Sheshagri Rao last week, who was saying that despite all the moves, there seems to be some more upside to steel. And I think we've seen enough evidence about there being bullish tones for the other non-ferrous metals as well. So my question is, metals and some of the other commodities, if they stay elevated for longer, can it kind of impede the momentum in these pockets?
Margin compression for sure in the short term. So we will see margins at risk and earnings at risk. Okay, but the way we look at it, and I'm not saying the markets will necessarily look at it this way, but the way we look at it is, if demand is in the way we think it will be, and even if margins are at risk, I will not get cautious. Okay, because we will see through this phase where margins are at risk, because at the end of the day, if demand is protected over a period of time, we think companies will pass on the price hikes. If demand gets impacted, that's when we will get jittery. Okay, so we will watch. We don't think demand is at risk. We think margins are at risk, and we are willing to see through a margin compression, demand protected environment, because ultimately, if demand is in and that's across sectors actually, if volume growth, second, top line growth is in line with how we think it should be, then we will not be, even if margins come down, we think it's a phenomena which could see some earnings downgrades, but we will not want to react to it, because ultimately companies will be able to pass on. But in the context of the consolidation point I told you, in the context of demand recovery, and how the balance sheets are prepared, we will see that you'll be able to pass it on, and that eventually will lead to earnings upcycle. This upgrades will come on higher top line, higher price, and that's when we need to be careful, should not extrapolate the multiples. We need to cut multiples then. Okay, when earnings get inflated, we need to deflate multiples. You're on mute, Neeraj.
I was trying to absorb what you were trying to say, Ganeshram, and interesting thoughts there. But yeah, I mean, thanks for giving us a snapshot. I mean, like I said, the first answer gave us a complete snapshot, and then I kind of probed a little to understand the nuts and bolts. But this was lovely, Ganeshram. Thank you for speaking to us today. And like I always say, look forward to talk to you more often.
Likewise, thanks a lot.
Thanks. And viewers, thanks for tuning into this edition of The Talking Point.